Hello value investors, thank you for joining me. In today's video we're going to talk about selectivity when investing. The topic came about when I went through Warren Buffett's 2019 meeting, and he talks about being selective when investing, that there's not been a more important time to be selective. So as we go through this video, I want to keep in mind what selectivity means. If you're new to the channel, please subscribe now so you can get my next video installment. Let's get started. So, small caps have fared quite badly over the last 5 years. So if you compare with the Russell 2000, and you'll see that over the last 5 years, the Russell 2000 is up approximately 7% over the last 5 years. That is not a great return, particularly when you compare with the S&P 500. As a reminder, the S&P 500 is top 500 companies in the US, and they are market weighted. So what is important to realize when Buffett is talking about being selective, while at the same time being bullish the market, he talks about very carefully how he believes that over the next 5 years or so, that the market most likely will be higher than it is today, and is fairly confident that over the next 20 years it will be higher than it is right now. However, you must consider investing in something that you're very familiar with in your industry. That doesn't leave you a lot of diversification. That's the first problem. The second problem is that if you're investing in something that is a household name, more likely than not, if you're looking at your Amazons or your Microsoft, these are amazing businesses. And while I believe that they can still have a very long runway ahead, I believe that there's a better opportunity available in small caps. So I'll repeat what I just said. If you're looking at, let's say, Facebook's and your Alphabet, which is a holding company for Google, if you're looking at Microsoft, looking at Amazon, these businesses will do quite well. The top 5 businesses actually make up 20% of the S&P 500. It is rare that the top 5 businesses make up such a large portion of the S&P 500. And those are very well followed businesses. So even though, let's say, for example, Microsoft will continue to do quite well, or Facebook may continue to do quite well, you're competing in those businesses with the largest hedge funds and the largest pension funds, and they have to buy those names. They'll be foolish not to. If you're holding a pension fund and you're not invested in one of the top 5 companies, I mean, it's going to be very, very difficult for you to keep your job. You'll be an outlier for not investing in those businesses. So if everyone else has already bought them, doesn't mean that they won't continue to do well over time, but there are better opportunities. So when it comes to being selective, that's the first thing I want to talk about. Do not just go for household names. Just look a tiny bit below the surface. It's not very difficult to just come for smaller cap companies that are doing quite well still, Even if you're just looking at, let's say, something that's 50 billion or below, that already kind of gives you a big enough spread. And if you come into 10 billion or below market cap, there's even more opportunities that people are not investing in. So be very conscientious about looking at businesses that generate strong free cash flow. I have a video about that can help you on your journey. But also, I want you to think about diversification. This is a topic that we talked about in other videos, and it's important to be mindful of how many stocks you should own. So before addressing how many stocks, remember the first rule that I always talk about when investing here? Aside from thinking about Buffett's rule number 1, do not lose capital, you need to start the investment by looking at the balance sheet. That tells you how strong the company's position is. Is the company restricted? Will it have to be playing defense now as we go through global contraction? Or does it have a net cash position generating strong free cash flow. You can certainly get many such businesses with a net cash position, strong free cash flows that are not expensive. It's just a bit of digging around. So look at the balance sheet, look at its current assets, look at how much cash it's got, and just look at how much debt it has. Subtract out the debt, and if you have a strong amount of cash on the balance sheet, you're good to go. Next, how many stocks should you own? So I elaborate that on a different video, but I believe that it's kind of down to your temperament. You don't want to have, let's say, 20 stock portfolio. The reason being, you're going to end up with many positions that are kind of just about right. What I mean by that is businesses that either you own because you thought 3 or 4 years ago they were a good idea, they have fallen in value, and you don't want to sell out at a loss, or businesses that are kind of just stagnated over time. So you got to be quite brutal with yourself when investing. You can't have a lot of emotions. You got to really just kind of go for the jugular. I mean, ultimately, you are trying to deploy the capital of your friends or of your own that will lead to maximum wealth over time. So over a 5-year horizon, a business that is not doing particularly well, or that is kind of come down quite a bit, there's no guarantee that it's going to come back up. Consider this. You buy a business at, let's say, $10 and it comes down to $5. Quite often the case. Businesses often fall down by 50%. Does that mean that the business goes back to $10 just because you want it to? No, the business goes back to $10 because it's worth $10. So, ultimately, you have to have a portfolio you have a certain amount of confidence over, but you shouldn't be too concentrated either. Having said that, having 20 positions is probably too much. So what is reasonable? So I often talk about Monish's portfolio, how he used to do a 10 by 10. A 10 by 10 means you have 10 positions, 10% weight in each position. So I think that works quite well for the average investor. Now, most people say, I'm not the average investor, I'm better than average. Everyone thinks they're better than average. But to be better than average, you got to be working harder than average. And that is easier said than done. Life gets in the way. So, I believe that the best solution is to have a strong amount of cash on the side that you can lose your job or someone else can lose their job in your family, and you can go at the minimum, at the bare minimum, 12 months without any income. Have that on the side. 12, 18 months, you don't touch that. After that, you can be fully invested, because if things hit the fan and you lose your job, you're not going to be having to sell out of a position immediately, and you can weather out the storm. This is very helpful portfolio allocation strategy. So having that 10 by 10 is quite helpful. The reason being that something comes to fair value sooner than something else, you can exit that position. Let's say it's 3 years down the road, something's worked out favorably, you can exit out that position, because the likelihood of you finding the next Netflix or the next Amazon is quite small. Very few businesses become like that. In fact, Jeff Bezos himself says that average businesses last 30 years, and that Amazon is already into its 20th year. So it's very difficult to find the next Amazon and to be able to get it at a position that it can go out very strongly. So you got to think about what Buffett says. Buffett always says, I want to be a buy and hold forever. That worked very, very well in the 80s. That even worked very, very well in the 90s for Buffett. That is not working out so well nowadays. You look at Buffett is exiting Apple. Like that, he says it's the best business he's ever seen. Sorry, I rephrase. He says that it's his second best business, that Geico was number one. But he says that is a terrific business. Nobody's selling out of it. It's not a buy and hold forever. It's quite a short turnaround on that investment. Same with airlines. The world is getting very disrupted. So having a 10 by 10 works out quite well. I work out with something slightly more concentrated than 10 by 10, but that is really hard work. You gotta be willing to put in the work every single day to have a more concentrated 10 by 10, and it might not be worth it. You can just walk around with let's say you split your portfolio into 50% into ETFs. You have the S&P and the Nasdaq. You put the other 50%, spread it out into your 10 companies, and that works out quite favorably. If you outperform the S&P, great. If you don't outperform the S&P, you still got the S&P carrying you forward. So, in summary, when you're being selective, I think it's important to walk out away from the household names. I think it's important to come for smaller cap companies with strong balance sheets. Having a 10 by 10 portfolio works out quite well. 10 positions, each one 10% weighted. Not having 10 positions but the top 6 really heavily weighted and then the other one smaller, because it's hard work. It can't be done. I do have a more concentrated portfolio, but you have to be willing to put in the work. So I hope you found this video useful, and I'll see you next time.